Hello! Welcome to the first episode of Series 6 of the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode we welcome a guest to the show to share their news story of the week, and I'm delighted to welcome Hartej Singh, Head of Public Credit at Pension Insurance Corporation. Welcome to the show, Hartej.
Charlotte, it's great to be on the show.
Lovely to have you here. Do tell us, what is your news story of the week?
So my news story of the week is that according to Professional Pensions, and they're referring to a PwC story, the UK DB pension surpluses have increased to 210 billion as of the end of the first quarter in 2026. I chose it because it's actually a good news story.
So we like those. There aren't many of those around at the moment, are there?
No, not at all. So not only is it a good news story, but I think it reaches so much more broadly than just this sort of fairly dry number. The good news is that pension plans, which sort of, I always think, 10 years ago, 20 years ago, is something that was perpetually in deficit and people were worrying about recovery plans and all the rest of it. It's finally, as an industry, in surplus. And I think that's fantastic. Mm-hmm. The second part of good news, it doesn't just end there, is that means pensioners who are relying on this income are now, much more secure in terms of getting their pension benefits on time and in full.
Well, that's good. That's great news. So, is there another reason? Is there a downside though to all of this surplus? Because it's great that we are in surplus at the moment, but we know that might not last forever.
Yeah, absolutely. So this touches across sort of two things which normally sort of stay away from each other. The payment of pensions and in general sort of markets like interest rates, asset returns. But it also speaks to things like corporate balance sheets, insurance. So our business, the capacity to then further secure these pensions. Regulation, as we know, the pensions bill is going through Parliament right now, and capital markets. If there's a sort of number that people should sort of think about is so for every pound worth of liability that actuaries calculate, there's £1.23, assuming what's called the low dependency basis, or £1.14 for a buyout basis. So there really is quite a healthy surplus. But the question you asked me is sort of, what is this all good news and sort of, all gravy? Well, no, it's not. Like, these are pools of assets. They've obviously had an incredible run. So risk assets have gone up and the liabilities have been discounted at an increasingly high interest rate. So this is a point in time surplus. This is not, money set aside that's, never going to be needed. This is just a point in time. The assets are greater than the liabilities.
And yeah, as you said, for 20 years we had the opposite situation where we were perpetually in deficit, and we, obviously we had interest rates that kept plummeting, and so eventually they could fall no lower, and that was really difficult for finance directors and for trustees of schemes. In theory, we could always go back there. I wonder, what is the probability of us returning there? Because we certainly seem to be in a world which is very different to how it was even 10 years ago, in that we have a lot more geopolitical risk. The impact of the aging population is really starting to drag down economic growth, the aging population. And it just feels like we're in a much more pro-inflation environment at the moment, though that may just be cognitive bias. So can we afford to feel a bit more relaxed that we're likely to stay at higher interest rates for longer? Or would you shoot me down in flames and say that's just complacency?
Well, it's a great question. And I think the premise of the question is, are we complacent? So whilst now we're thinking about higher oil prices and high rates, and the fact that sort of inflation has been really volatile, all the way since the sort of COVID period, where it's either been very low or very high, and sort of has been quite volatile since. I think right now the market understands that that's the picture. So the interest rate reflects all this. So So let's say, what's a scenario where, for example, that surplus could go into deficit again? Well, it would be that asset markets sell off. So, for example, a lot of people are complaining about valuations. As we know, a lot of the sort of assets, are either reliant on AI or could be disrupted by AI. So, if risk markets sell off, that's one way to get you sort of to reduce your surplus. The other one is, imagine if in a year's time there's a recession. That might mean that UK interest rates decrease because the sort of Bank of England is able to stimulate the economy due to reduced either inflation or reduced growth. So I think right now it seems impossible that we'd ever lose this surplus. But I think this is exactly the point. Whereas 10 years ago, it never felt like we'd ever get out of these deficits. Now everyone thinks they're a hero because they're sitting on a large surplus. But it's only a surplus if you then take the risk out of it.
Mm. And I mean, to be fair to pension schemes, and I mean, I call that the lucky fool argument. The idea that somehow you're a financial genius when you've just ridden a particular market trend, whether it be London property prices or interest rate cycles. It's easy to sort of flatter yourself and think I'm a genius when it's nothing to do with you at all. How do we kind of in that environment where you talk about, you need to make sure that you've hedged the risk, and schemes have done that a lot. And even in the face of the Liz Truss crisis, schemes are not like they were in the 1990s. We're not really seeing that many we don't have them anymore, contribution holidays or people sort of, taking that risk back off. They're very keen to lock that surplus in and keep it there. But should they be doing other things from an investment perspective? What things are you doing as an insurance company when you're thinking about your investments? And in this environment, we're preparing maybe for a situation where we don't have surpluses forever.
Yeah, I mean that's that. So I think the key point is the surplus is a real surplus once you've effectively immunized the investment risk and the rates risk and longevity risk. So one way of doing that is effectively by going to buyouts, and that's obviously sort of one potential end game. Some people are thinking about run-on or super funds, but I think to truly call it a surplus, I think you have to immunize the risk. So that's sort of going back to that the buyout index number, which is 114%. So when it comes to a buyout, the longevity risk, the interest rate risk, and a very prudent amount of capital is held against these assets and liabilities, such that through very, very large stresses of the world, we know that those pensions are going to be paid on time and in full.
Yeah. Okay. And so from your perspective as an insurance company, as you are riding that buyout wave, which we've LCP has put a forecast of 550 billion flowing into the coffers of companies like yours, life insurance companies like yours, over the next decade. Talk to us about how you're thinking about investing that money and what you see as the sort of the choke points. Because as an insurance company, you've got things to think about you can't invest willy-nilly, right? You are
absolutely
tightly bound by regulation and by the fact that you are investing these to pay liabilities a long way in the future. So your investments have to reflect that time horizon as well.
Absolutely. So the pension, the pensions we're paying and the regulatory environment, those are sort of two north stars for us. And so what if you're to pay some sort of a sterling amount in 30 years' time, what would you want to invest in? So you want to invest in things that you have a very, very high degree of comfort is going to repay back without any sort of delays in cash flows. That tends to mean, you want to lend to high quality companies or against infrastructure with really, really good downside protection. So, for example, if there are any challenges overall, you think there's enough cushion in the business such that it will be able to pay its debt and sort of work its way out of trouble. We think about recessions as happening once every, call it 6 to 10 years. Over a 30-year period, you're underwriting 3 to 5 recessions. And so the quality of assets that you need in house are need to be strong. The next point is regulation. I think it's been sort of well flagged that the matching adjustment regulation does really sort of guide insurers into fixed income sort of assets, and particularly ones that have very little cash flow variability. That's obviously part of the sort of Solvency UK reform. But even then, the vast majority of assets need to be very, very fixed in terms of their sort of cash flows. So whether it's in public form or private form, often there's sort of a lot of people see them as separate markets. But in general, if you're sort of buying fixed income, you're looking for high quality companies, and we can talk about some of the areas that they might be coming from.
Yes, let's. I mean, and another point as well is because you are the pension insurance corporation, you're based in, a lot of your business is based in the UK. A lot of liabilities you're paying in the UK, so you are going to favour UK assets, aren't you? You're going to favour UK sovereigns and UK corporates. How do you weigh up whether you choose the domestic market or you choose an international market and then having to add a currency hedge? How does that kind of play out in your mind? Or even in your mind, in your portfolio even?
Yeah. So I mean, that's a great question. So if sterling cash flows is what we will ultimately, pay out, there's huge benefits in being invested in sterling. If we invest outside of sterling, we need to manage the currency risk. And in volatile markets, that could mean that we need to pledge collateral or set liquidity aside in order to meet those sort of derivative needs. But let's say, like in terms of the main question, sort of would we put all our assets within the sterling market if it were possible? I think the key sort of problem there is the diversification within our sort of set of assets. There isn't the sort of the scale, the spread, and the diversity that we need. And so many investors in our seat, we sort of tend to look overseas. But I think there's actually more appetite for UK assets than there's supply. So I think this is the big story that sort of doesn't get spoken about enough. When we speak to our peers, there's often a sort of an unmet demand as opposed to sort of too much, rather than the supply not coming because there's not enough demand. And if I want to give you like a sort of an anecdote, we can help build an airport or a hospital system or a sewer system in the US 5,000 miles away, but it would be very, very hard to, on an off-the-shelf basis, invest 5 miles away. And that to me is the sort of the conundrum and a great opportunity in terms of making the UK asset pools more reflective of that sort of UK infrastructure opportunity.
And so what do we need to do to make that, to expand the availability of UK assets? What lessons can we learn from the US? What should policymakers and institutions like yourself be doing differently?
So I think the fact that we as a London-based, a UK investor, have looked at the documents in the US municipal market, have seen that there's some great assets available. I think that's the model. So there are kind of two ways you can create more proportion of UK assets being invested into the sterling market. One is by forcing investors into it, the sort of the stick approach. But another one is saying, right, we want access to the world's investors. How do we create a large scalable opportunity for them to invest in? So as an example, let's say there were a UK municipal market, and any housing association, any university, any utility could in some way tap into this, like particularly where there's a public ownership angle or a public interest angle, in a standardized way where we're very serious about actually building rather than sort of constant sort of delays in terms of the actual sort of planning and regulation aspect of it. If we were serious about all those things, there is a huge opportunity to meet the demand of UK investors for great UK assets. And then you get the win-win, which is sort of UK investors finding good assets that have a secondary impact of having a huge positive impact to their sort of local environment, local economy.
But I get that, and I've long not really understood why we don't have some form of, which what you're basically talking about is kind of an infrastructure bond, whether you build it via a municipal bonds market or another way. And we've certainly got, within pooling and the LGPS as well, we've got lots of interest there in terms of marrying up pension scheme money to local infrastructure projects. So it seems to be sort of inching our way towards that. But is there a situation where maybe we need different types of investors at different points along the journey? So you made the point, didn't you, that insurance companies like things to be very predictable, very long term, have to be matching adjustment compatible. But if we're doing it may be a while before we get to that stage, right? If you build a motorway, it's a while before you can actually start charging the tolls, for example. Do we need kind of like a broader ecosystem of who comes at what stage along the development process as well? Maybe it's venture capital being with or private equity, and then it moves on to the insurers a bit later on. And even a lot of the pension schemes don't really want to get involved in kind of like the very early stage stuff that could be risky.
Yeah, so I think there's some great points to follow up there. So number one, you're absolutely right. Like, someone has to get the approval. So, for example, like a project is particularly risky when you feel like there's a risk that it doesn't even get approved, and there's a lot of cost in getting that approval. I think, as you rightly said, that is likely to be borne by sponsors or the people who are providing the equity. But even sort of at that early stage, that's quite, that can be quite a small percentage of the project. Often it's the visibility around funding that tends to be sort of quite an issue. And I think that there are pockets for that construction risk, even in rated fixed income form. So I think the access to financing is available, once the approvals have sort of really been nailed down. I really think there's just far too sort of cumbersome a voyage from idea to approval, and shortening that some way, either through some of the ideas that are already coming out of government, which is off the shelf type approvals, a very sort of one-stop type of sort of approval mechanism that can make this easier. Like, if we make sort of that approval process quicker, we're actually making the most expensive capital. So normally the sponsor capital, the equity capital, is the most expensive capital. We're making that work, for less time, and therefore the required rate of return on the whole project needs to go down.
Yeah, I think another point for you that people don't talk about enough, which somebody made to me quite a few years ago, is the issue we have in the UK. And one of the reasons why we're so slow at infrastructure is kind of because our legal system is the way it is, because of common law, because basically we do kind of enshrine property rights and allow people to, that's kind of been, souped up, but there is this sort of fundamental sort of tension at the heart of our legal system in terms of being able to really motor through things and get things approved rapidly, and that maybe needs to be looked at too. And the point I'm trying to make here is that it's policy needs to be looked at from end to end, soup to nuts, as the expression in the US is, which I never quite understood. Why do you eat nuts at the end of a meal? But, that kind of looking across the whole long and making sure that, each government department isn't in their own siloed little world and thinking about what they need to think about, but you've actually sort of done enough to make everything happen and flow in a very smooth way. Because the weird thing about being in the financial services industry, like particularly insurance, right? You're so heavily regulated, and yet you're kind of like told to do stuff, but you're like, well, I'd love to, but could you sort this up a bit out for me too? Because you're regulating that as well. So there is that kind of weird tension that I sometimes think we forget in financial services, how heavily we are at the behest of regulation, and how you could make or break a business model on a rule, really.
Absolutely, and I think it's the excess of caution. So I think in order to not make any mistakes, you end up sort of making everything very difficult to do, and it's always a trade-off. Like, no one's ever thanking a politician for if they made things easy and there's mistakes happen at the end of it, they're on a tough wicket as it is. I think let's if we think about what do we need to happen in 20 years' time from a sort of pension perspective, from a government perspective, from an economy perspective, it is trying to solve this infrastructure build out. Like how is it going to be financed? So if you think about like just off the top of my head, if you think about the shortage in housing or the opportunity in housing, the opportunity to build out the energy infrastructure, transport infrastructure, data centers, there is an enormous amount of sort of huge and valuable updating or addition to the infrastructure that we're currently at the start of, and it's how do we get the capital that's sitting in the UK and abroad to finance it? So how can we be a good place for global investment? If we can crack that, then the UK market itself, the pension funds will be able to benefit from fantastic returns. Will pay their pensioners in full and on time, and I think the pensions bill. Not only is it sort of trying to professionalize and make some of the really fragmented industry, like trying to bring it together with great expertise, but I also think that on the surpluses front, sort of getting a very sensible policy around surpluses, such that when people immunize the risk of their pensions, that they can potentially take the benefit of some of those surpluses. That surplus will then go back into the economy because it's going to the company. So there's lots of ways that sort of almost good regulation and clear regulations, i.e. if you do this, then this is the benefit for you, that can really unlock all this capital and the opportunity of building out the UK economy.
Yeah, and to your point, just bring us back round to where we started before. If LCP is right, and you've got 550 billion flowing into insurance companies over the next decade, you're going to be actively looking for more UK assets, aren't you? Because you want to match those liabilities to UK sterling. Makes sense to match it to the country where the scheme members actually reside. So, given that we have a big wish list here, can you talk to me about how you're thinking about investment innovation? How do you expand that investable universe? Whether it's about creating innovative products that maybe help you invest in places that you wouldn't do because of financial regulation, or if you're expanding asset classes, or how are you thinking about that for the next sort of 5 years? Where are you going to be investing?
Yeah, it's a great question. So I think the opportunity just in UK infrastructure, I think, is massive. And if you think about the UK, and the sort of the challenges and opportunities the UK is trying to sort of work against and work towards, that is replicated in the US, in France, in Germany, amongst other EU sort of neighbours. I think so. I think building out the energy infrastructure, for example, building out the electricity grid, even that is an enormous sort of opportunity. And the sort of second part is we know that there's tons of capital needed here. The question is, how do we make it insurer friendly? So what makes it insurer friendly is strong protections, but also good efficient capital treatment. And so sort of making sure that they have those protections such that investors like us can invest in it. That's the sort of the Venn diagram where the opportunity and the sort of ability meets. In terms of really innovative structures, I think it is fair to say that the very early stage, or sort of coming to fruition ideas, that does not tend to sit so well with insurers, particularly where there isn't a history to point to, or for example, it doesn't feel like the value of the assets can survive if, for example, that industry goes through challenges. So given that we're there to sort of pay the pensions out, we probably aren't going to be the first call for highly innovative new risks and being the first to take those. But I think we certainly will be at the front of the queue where it comes to innovative structures that help us take the risks that we believe to be the most secure.
And could you give us an idea of what those innovative structures would look like? I mean, one that sticks with me is something that one of your Aegon did, I think, which was around investing in frontier markets and putting an insurance wrap around it to make it palatable to insurers. I mean, is that the kind of thing that you're looking for in terms of innovation, or is it simpler than that?
So that's like that is obviously sort of innovation around gaining access to new risks and sort of working with insurers to sort of make that risk easily sit on a regulated balance sheet. I guess to go to the really vanilla the really vanilla end, it would be working on security packages such that, let's say, a very good borrower who's currently cash strapped can effectively pledge assets that they haven't had an opportunity to pledge before, and fund against that. There are often companies for one reason or another, very good ones, who have very strong cash flow but just no upfront capital. And if they want to sort of achieve that upfront capital, sometimes the most innovative thing to do is just effectively allow them to find financing in a way that they hadn't sort of envisaged before. And I think that is actually something we're probably going to see a lot more of. So, for example, whereas corporates tend to issue regular way bonds in unsecured structures, if, for example, they can find access to secured structures where they're pledging particular assets, that might attract a different type of investor.
So are you talking about sort of emerging between the sort of an ABS type structure, which usually tends to be in private credit, but bringing that into the public markets almost?
Yeah, like the public and private markets are, that line is becoming grayer than ever, and the reason is that private market type technology is reaching investment grade corporates.
Mm-hmm.
And the way that's executed, it can be done in the public market, it can be done in the private market, but the idea that sort of private credit is access to small companies, that's sort of no longer the case. Private credit operates in all sizes of companies, and it's more to do with the innovative structures and security packages that might come with it.
Okay, that's interesting. The other area of innovation, maybe, or something that you need to think about, is you are multi-decade investors, right? You're paying out liabilities for, say, 20, 30, 40 years. I know it's become sort of untrendy to talk about sustainability, but given everything that's going on in the Strait of Hormuz and the fact that we're kind of in 1970s, complete with the brown and the flares again, and an energy crisis, it's kind of sustainability could come back onto the agenda, from a sort of like a news perspective and a short-term perspective. But that's obviously, it's not something you can ever really take your eye off the ball when it comes to investing over those long periods. So, I mean, how do you think about that, making sure that, for example, that you don't, and from just a risk perspective, don't end up in stranded assets, don't end up in the wrong investments that just go belly up, with the fullness of time. You talked about investing in infrastructure, getting ahead of the green energy technology solution, or even like trying to encourage companies to make the right decision. And do you ever feel frustrated with the constraints of your investment universe that you can't do as much as you'd like to?
Yeah, so I think if we rewind 5 years, you could not move anywhere but hear about ESG. It was at the time, and the loudest people then have completely backed away from it now. So it was almost a marketing channel rather than a sincere expression of long-term risk. We have neither the luxury for marketing ourselves as the AAA star, nor given the fact we are long-term investors, could ever be complacent not to fully consider it. So I think now the good thing is sustainability has had a lot of its sort of loud empty vessels sort of move out of the way for sort of serious conversations to happen. So sustainability is moving into a more mature phase. It's integrated into underwriting. Like if people aren't considering legislation risk, if people aren't considering litigation risk, if people aren't considering what would be the impact of a change in the climate, or indeed sort of if energy mix was different. If you're not doing that, I don't think you're really underwriting to the kind of decades long underwriting that you need to. The other sort of additional thing that's probably been discussed for the last 3 years since the LLMs have come out is obviously technology risk, where business models can just be deployed in a very, very different way through new technology. So I think when we look at all those long risks, what is sustainable to me is something where there is a very, very clear need for it. It has very, very low costs to other people and large gains. It has a general buy-in from not only the people that use it, but the people who are around it, the people that legislate it, and so sort of sustainability is very much within our thinking, and that's, I think, another reason why things like housing and infrastructure and energy and data centers are places where you're just going to see continual deployment, because there is a view that this makes people's standard of living higher. Mm-hmm. And that has to be sort of part of it. If, for example, we were sort of lending to a business that has ridiculous addiction issues and generally sort of leaves people in a worse state than when they interacted with the product, that would obviously be something that that wouldn't work for us.
Well, to be cynical about it, they just really don't invest in equities then, since that you've just described kind of the Magnificent Seven, really, there, haven't you? With addiction issues and making people feel worse than they have done in the past. But I think that is a great place for us to end. I think we've had a really great discussion, covered a lot of ground in half an hour. So I want to say thank you so much, Hartej, for being here on my podcast. You've been a great guest. Wonderful to restart Series 6 with you. And if you're a listener to the podcast, then make sure you hit the subscribe button. Please do engage with the podcast, take part in our Spotify poll. And as ever, thank you so much for listening.
Thank you so much, Charlotte.